Welcome to The Explainer. We're here to break down the numbers and the narratives behind some of the market's biggest moves. And today, we are definitely unpacking a complex one, PagerDuty's latest earnings report. Okay, so let's get right to the heart of it, because this is the real puzzle. PagerDuty comes out, they post a solid beat on both earnings and revenue for Q4, and what happens? The stock gets absolutely hammered, dropping over 10% after hours. So what on earth is going on here?
To figure that out, you actually have to start with the good news because, on paper, if you're just looking backwards at the quarter that just finished, the company actually showed some seriously impressive execution.
Firsting, just look at the bottom line. PagerDuty delivered a really clean beat here. We're talking non-GAAP earnings per share of 29 cents, which nicely cleared the 24-cent consensus. Right off the bat, that tells you they're managing their cost really effectively.
And it wasn't just about profits either. The top line was strong too. Revenue came in ahead of what everyone was expecting, at nearly $125 million. So you've got a beat on the top and bottom line. I mean, usually that's a recipe for a pop, not a drop.
And when you dig a little deeper, the story just gets stronger. This was their third straight quarter of actual GAAP profitability. That's a huge milestone. They posted a super healthy 23.9% operating margin and were just cranking out free cash. And on top of all that, they even grew their biggest enterprise customers by 10%. I mean, these are all signs of a really well-run business. So with all that good stuff, why did the stock tank? Well, the answer isn't in what they did, it's in what they said they were going to do. It all comes down to the guidance. And this is it. This is the slide that tells the whole story. Management's forecast for full-year revenue? Well, it was about $10 million below what Wall Street was modeling, right at the midpoint. For a software company, that is a pretty significant miss on expectations. And really, when you do the math, what this guidance signals to investors is a company that's preparing for basically zero top-line growth in the year ahead. And in the world of software investing, where growth is absolutely king, a flat trajectory like that just completely wiped out all the good news from the quarter. So what you have now is this disconnect that creates two totally different competing stories. You've got management telling this long-term story about a big strategic transformation, and then you've got the market, which is laser-focused on the immediate slowdown. On the earnings call, you heard CEO Jennifer Tejada paint this really bullish long-term picture. The vision here is to position PagerDuty not just as a tool for when things break, but as the essential platform for managing this whole new complex world of AI-driven operations. So management's whole argument is, hey, we're in the middle of a major pivot here. They're moving from a seat-based model to a more modern consumption model. They're building out a big AI ecosystem. They're trying to basically own this new AI ops category. The bet is that this will make their customers stickier and get growth going again, eventually. Yeah, that's the long-term vision, but investors, they want proof today. So they looked right past all that and zoomed in on one key number that tells a much more cautious story about the business right now. And that number is 98%. That's their latest dollar-based net retention rate. For any subscription software company, this metric is absolutely critical. So why is this number such a big deal? Well, when your DBNR drops below 100%, it means that on a net basis, you're losing more money from your existing customers through churn or downgrades than you're making from them expanding their use. It's a signal that your customer base is actually shrinking, not growing. And that is a major, major red flag. Okay, so let's put it all together. You've got this profitable company, it's got a really compelling AI story, but it's facing flat growth and a customer base that's on net shrinking. So what's our call from here? We're giving this a market perform reading. Look, the company's profitability puts a really solid floor under the stock. It's not going to fall off a cliff. But with growth stalled out, there's just no clear reason for it to go higher in the near term. We really expect the stock to just be range-bound for a while. The key catalyst that everyone is going to be watching for is pretty simple. We need to see tangible proof that this whole AI strategy is actually driving revenue. And most importantly, they have got to get that DBNR metric back above 100%. And really, this brings us to the final big question for anyone looking at PagerDuty today. Is this a classic value trap? A stock that looks cheap but just keeps underperforming because its core business is eroding? Or is this a genuine deep value transformation story where management can actually pull off this AI pivot and unlock a ton of value from here? Honestly, the answer is going to come down completely to execution. And of course, as always, this explainer is for informational purposes only. This is not financial advice.